Howdy everybody, welcome back to another round of Accounting 1101 where it is closing time. Now when I say that, don't get too excited thinking, we're about ready to wrap up the entire class and you can ride off into the sunset. We're not talking about closing down the class, we're talking about closing our books at the end of the accounting period. And so maybe it's the end of the month and our accounting period is over and it's time to close up the books and get them ready for the following month. We're going to talk about that process in our video right now. In our next video, we'll show you how to make the entries to close out the books at the end of the accounting period. So, before we get into that, let's talk a little bit about where we have been. Now, we've been working through a thing called the accounting cycle. The accounting cycle happens every accounting period. And it kind of encompasses everything from putting the transactions into the accounting system to cranking out the financial statement. Of course, we have a lot of steps in between, don't we? All of that put together is our accounting cycle. We begin by identifying transactions that have happened and analyzing them. And then we put the transactions into the journal, don't we? We write them out in the journal. From there, a step that happens a lot of times automatically in your computerized accounting systems, the transactions get posted from that journal into the individual ledger accounts, don't they? We can keep a running balance of what is in every single account. So we've done step 2, we've done step 3. That was earlier in, I think, chapter 3 it was. From there, we make an unadjusted trial balance, step 4 of the accounting cycle. We make that trial balance to be sure that our accounting system is in balance. Debits equal credits. Once we have that, we move ahead and make the adjusting entries. In chapter 4, we learned about how the books need to be cleaned up a little bit at the end of the accounting period to reflect for things that have happened during the period that haven't yet been recorded in the accounting system. So we make our adjusting entries. And then we make yet another trial balance. We make an adjusted trial balance. From that trial balance, we can make our financial statement, the kind of end result. So that's really where we've been. We've been doing steps 1 through 7 in that accounting cycle. So what about step 8? The closing process. We make our closing entries, as I mentioned. We'll show you how to make the entries in our next video. And then we make yet one more trial balance. We make a post-closing trial balance. So really there's kind of 9 steps in the accounting cycle. And what we learn in the first part of any accounting class, whether you're taking it here, whether you're taking it at Ohio State, Wright State, wherever you might be taking it, is the accounting cycle. You learn about the various steps and how to complete them. If there are any reversing entries, we don't really get into that a whole lot in Accounting 1101, but those would be made after that post-closing trial balance. And then guess what? The beautiful, wonderful thing about accounting is you get to do it all over again the following period. Yeah, it never ends. It's like Groundhog Day. It's the same over and over, every month, every month. You do that accounting cycle. So, our game is over. We've made it to the end of the period. We have our financial statements. And I just have our example business up here, Printing Plus, and we kind of start off by making that income statement, don't we? So we can figure out the amount of profit that we made, our net income. Revenue minus expenses is net income. That net income number is needed to calculate our retained earnings, either on a statement of retained earnings or the statement of shareholders' equity. And so you can see that net income number comes down. We use it to calculate retained earnings, and then that retained earnings number goes over to the balance sheet. So the statements are kind of connected there, aren't they? But our game is over. We've played a month of business, the goal of which was to try to make as much money as we possibly could, right? And so we did. We made $4,665 in profit in our example business in the month of January. January's over. Time to move forward to February and start a new accounting period. But before we can do that, we have to acknowledge we're at the end of the game. If you've ever been to a sporting event before, maybe you've been to a Reds game, maybe you've been to a Bengals game, you know at the end of the game, there is a score. There's a winner and a loser. You can see one of the rare occasions where the Reds have pulled out a victory. They beat the Pirates on this particular night 11-3. Bengals won their game. Game's over. When those teams come out the following week or the next day, the scoreboard doesn't say 11-3, does it? They don't pick up from where they were yesterday and use yesterday's score as a starting point. No. They set it back to 0, don't they? Reds and Pirates come out the next day. The scoreboard says 0-0 in the top of the first. A new game has begun. They reset the scoreboard. We have to do the exact same thing in accounting, y'all. We reset our scoreboard back to 0 before we begin a new game or a new accounting period. And so you think about that scoreboard. The Reds and the Cubs here. You think about that final score. It gets reset back to 0 before they play the next game, doesn't it? But some statistics, some data doesn't get reset back to 0. You think about the wins and losses, the home runs, the hits, the strikeouts. Those all get counted and carried forward, don't they? And so it's the exact same idea in business, if you want to kind of keep that game analogy in your head. In business, our game ends at the end of the accounting period. In this case, we're looking at a month, the month of January. At the end of January, we have a scoreboard here. The income statement is our scoreboard. It shows how much money we made in that month. We need to reset that back to 0. So when we get to February, February's revenues and expenses aren't including stuff that happened in January and the game before, right? Think about the balance sheet. When you get to the end of the month of January, would you reset your cash back to 0? Now think about that for a second. In your personal life, if you had $24,800 in your checking account January 31 and the bank reset it back to 0 because it became February, you'd probably have a problem with that, wouldn't you? Now, maybe you would like it if your liabilities got reset back to 0. Maybe you have a credit card debt or a vehicle debt loan, and they reset that back to 0 the following month. You'd probably enjoy that. But that's not the way it works, is it? Everything on the balance sheet remains. The stats remain. The cash, the accounts payable, the retained earnings, the equipment, all of those stay as they were in January. We don't reset them back to 0. All right? That makes sense? So we have some fancy accounting terms for these accounts. The income statement accounts, which are reset back to 0 at the end of the period, reset the scoreboard, are temporary accounts, meaning they only really carry a balance for the accounting period, and then they're reset back to 0. The balance sheet accounts are permanent accounts. We never just reset them back to 0. You know, they may go back to 0. Let's say we spend all our money and we have 0 in cash. It can go back to 0, can't it? But we don't just arbitrarily reset it back to 0 at the end of the accounting period. They're permanent. Our goals when we talk about the closing process, we're going to take that adjusted trial balance and we're going to understand which accounts are going to get closed out. We're going to understand what closing even means. I've said closing probably 50 times in the video already. You may be sitting there thinking, what the heck does closing even mean? Hold on to that thought. And then, of course, we need to be able to make the actual accounting entries because we're in accounting class, and if we don't learn how to make accounting entries, I don't feel like you're getting your money's worth. You will not be a competent accountant. So which accounts exactly are going to get closed? As I mentioned, your income statement accounts are going to get closed. Your balance sheet accounts are not. So there's my balance sheet accounts on that trial balance. They are permanent. We don't reset the cash account. We don't reset equipment. We don't reset accounts payable. We don't reset balance sheet accounts back to 0. They are permanent. Temporary accounts are the income statement accounts and that dividends account. We are going to close them out. And so what does closing an account even mean? It means we're going to make that account 0. We're going to zero it out and wipe it out. Closing simply means we are zeroing out an account. And so just to kind of show you here, we have service revenue, $10,100, a credit balance there, right? So if I'm going to make that 0 and wipe it out, I have to put an entry that puts that number on the opposite side, the debit side, and then it will wash it out to 0. So closing simply means zeroing out an account. Like I said, there's service revenue. You can see the T account, 10,100 balance. We make an entry, debit entry for that same amount. Opposite side, it balances out to 0. Now, I didn't show you the other side of what that entry would be. That's going to be our next video. In our next video, we're going to record the 4 closing entries. I'm going to show you how to do it step by step. Our final video for the chapter, we're going to talk about making the post-closing trial balance and talk about why that particular report is important. As always, if you have any questions about accounting, anything that you've read in the book, anything you have tried in your homework, or maybe I've talked about in a video, let's have a convo. Feel free to reach out to me. I'd be happy to help. In the meantime, take care, everybody.